For more into the markets and the economy for China, I spoke to Nicholas Lardy. He's a senior fellow at the Peterson Institute for International Economics, and I asked him whether or not the market now is, I guess, stable after the recent rebound.
I think multiples are still fairly lofty, particularly in the Shenzhen market, and the market could grind lower over the next few weeks. We're down about 40% from the June 12th on the Shanghai Composite. There could be more to come. Remember, the correction after October 2007 was 70%. The market was more hyperinflated then than it was this time around, but this is a very volatile market, and markets tend to overshoot, and I think especially retail, rumor, liquidity-driven markets like in Shanghai or Shenzhen.
A lot of the concerns was the Chinese stock market is overheated. Fair enough. Then there was talk about the economy perhaps slower than what some people expect. Then there was the collapse of commodity prices, which would reflect those concerns. Now, over the past 12 to 24 hours, we've seen a spike up in oil prices, and I'll include that in the greater basket of commodities. And I'm wondering, in your mind, is it possible that commodities may have already overreacted to any concerns about a possible slowdown, whether it's in China or anywhere else in the world for that matter?
Well, remember, commodity prices have been on a long, slow, but very persistent and cumulatively very large slide really for about 5 years. If you look at the Bloomberg index or any of the other indices, what's happened in the last few weeks is just a little squib on the whole story, which is basically down, down, down. Some of that is a reduction in the demand in China. And for some commodities, it's an increase in the supply. Certainly with respect to iron ore and oil, the supply side has also been quite important. So I think there is a fairly long-term decline in effect that it's hard to see being reversed significantly on a sustained basis until we get stronger growth, not in China, but in the rest of the world.
You recently got a lot of attention from an article you wrote to the New York Times, basically sharing the relationship between the stock market and the overall economy. You basically has insinuated that say that the two really are uncorrelated because so few people actually, I should say, so few normal people, regular people actually own a lot of these stock names in China. I want you to elaborate for our audience that is watching sort of the synopsis of what you wrote in the New York Times and why you decided to write it.
Well, I think a lot of the press coverage, particularly in the West, has been, quite frankly, misinformed and extrapolating from the stock market to asserting that the real economy is weakening dramatically. And so I think it is worth going back and reviewing. From the peak in 2007, in the fall, the market fell 70% and without much effect on the real economy. So the economy was doing well, the market was tanking. From the middle of 14 through the middle of 2015, the market was on a soar, just on a tear, and the Chinese economy was doing reasonably well, but in 2015 they're growing at 7%, in 2014 they were growing at 7.4%, so the economy was slowing down. It certainly wasn't very buoyant, and prices on the Shanghai market went up 160%. So again, no connection between what's happening in the real economy and what's happening in the equity market. And I think the same thing is true since June 12th. Prices have collapsed by 40%. And the best evidence, I think, supports the view that the real economy continues to be moving along. Maybe it's not exactly 7%, but we have strong consumption demand. The service sector is growing rapidly. Wage growth is still fairly strong. This is not an economy that doesn't look like an economy that's going into a slump or about to go off the cliff.
But Nick, you can understand why there's so many critics out there who, and I'll just take one particular move by the Chinese Central Bank, the PBOC, with respect to the renminbi, how that's caused a ripple effect of concern around the world. I mean, you're welcome to address the situation in terms of whether or not you think that is a precedence that's being set, that every time there's an issue in the capital markets, that they're going to use monetary policy to essentially change sort of, I don't want to say the rules, but at least the Chinese do have an advantage when the renminbi is weaker, right?
Well, but the weakening of the RMB is very modest so far, and I don't think it's been designed to prop up the real economy. They want to move towards a more market-determined exchange rate, and they took a step in that direction earlier this month. I think they're following it up to a considerable degree by allowing the close on one day to be an influence on the price set to begin trading the following day. So I think it was a move in the right direction.
New relaxation of property investment rules into China. For those viewers that are watching, the old rule is foreigners can buy one piece of property in China. They want to blow that wide open and let foreigners buy multiple properties in China. Impact on real estate, impact on the economy, if any, Nick?
Well, you know, I think one has to begin by recognizing that the Chinese domestic real estate market is gigantic. And in the aggregate, an additional amount of foreign demand is not likely to make much difference. However, it could make a difference in a few cities. In the main coastal cities where foreigners tend to congregate, want to live, their additional participation in the market there could be significant. But those are the markets that are already doing very well. This is Shanghai, Beijing, Shenzhen, Guangzhou, places like that, where the market never tanked as much as it did in other places and has had a fairly strong recovery.